Today I want to take a look at a German company called TeamViewer, and we'll start by taking a look at the three primary use cases that they address. So TeamViewer is perhaps most known for their what they call remote desktop connectivity software that allows you to connect from one computer to another. And you can see here the first use case on the left, immediate remote support tools. Think of that as the extranet where a company is going out and connecting to customers' computers, perhaps to help them troubleshoot a software installation, for example. Then you have this middle component, managed enterprise connectivity. That may be where your IT support team connects to your computer at home and helps you figure out why you can't do something when you're working from home. And then on the right-hand side here, you see this operational workflow optimization, and that's the augmented reality component. To be honest, I've always been quite suspicious that there's real use cases, real value to be had there, even though there's been a lot of money that's poured into that. One questions if companies are able to actually use that and have it add value. And according to TeamViewer and others like PTC, indeed they are. Now, when we look at the total addressable market for these three areas, the first thing to note here is that enterprise, you can see on the right-hand side, these bars. In the middle is 2021, so $19 billion opportunity. But look there, you have enterprise and small to medium businesses are about equal. But when you move to the right there, you see how enterprise jumps as a percentage of the total pie, and so does the total pie to $37 billion. So on the left, you can see where they're breaking down that $19 billion opportunity in 2021 based on their various use cases, with immediate remote support tools being close to half of the opportunity. So when we look at competitors in that area, you can see here, this is taken from a firm called Trust Radius that does reviews for software products. And the estimate is that TeamViewer is a dominant provider of this particular software, which is good because we always want to invest in leaders. Now, the last time we looked at TeamViewer, and I'll put a link to this article in the description of the video along with another piece that we did on TeamViewer. The last time we took a look there, you can see the title of this article is "Why is TeamViewer's Stock Price Falling?" And below that is a chart. You can see that dip in the middle where the volume increases. That was around October of last year, late October, when the stock price took a massive dump. And the reasons for that really were that management fell on the sword. It's hard to imagine an earnings call that could have gone worse. It was horrible. And our take on that was certainly we weren't going to sell our position at the bottom. We hoped that management got all the bad news out of the way and that they would be able to turn things around and earn their big salaries. You can see on the left-hand side here, the last 4 quarters, that's revenues and earnings. So they're a profitable company, and they've been able to consistently grow revenue. Certainly not at the pace that we'd like to see, but they're still enjoying some consistent growth, which is great to see. So the last time we looked, they were having problems converting free subscribers to paid. So they said they'd need to focus more on upselling existing clients. They had somewhere around 600,000 clients using their solution. And because of the Rona, that initial demand for remote connectivity had fallen away, and their net retention rate fell to 88%. That's the amount of money that existing customers are paying them. At 100% means they're paying the same. That means their existing customers are paying them less. That's not good. And they talked about how enterprise customers were very important, as management believed that these higher spending clients would be easier to retain and upsell. But then the CEO says this, honestly, I can't tell you how the enterprise conversion will work and how that will then contribute to the overall growth. As I said, the call was an absolute disaster. Now, when you look at the percentage of enterprise revenues as a percent of all revenues, you can see that it's now around 20%. So they're certainly growing that over time. And when we look at the most recent earnings call, so this would be for the first 3 quarters of 2022, and we can just pretend for all practical purposes that euros are dollars, because they really are. I think 1 euro is equivalent to $1.03. So revenues for this year The remaining quarter needs to be booked, of course, but they're expected to fall within a range of 565 to 580 million euros. On the low end, that's growth of about 13%. On the high end, 16%. Not horribly bad. And then when you consider growth from 2020 to 2021 was roughly 10%, the company is still doing decent. We look through their earnings call and what's transpired over this year. First of all, they brought in 2 new individuals. Here you can see these 3 characters here. This is the executive board. On the left is the chairman of the board and CEO. That's not good. That's like somebody being their own boss. We talked about that before. Gentleman in the middle is a new hire, CFO. Their last CFO, they didn't renew his contract. He was likely thrown under the bus for the horrible event that took place last year. And then this gentleman on the right comes from Avast, which is a Czech cybersecurity firm, pretty large, and he's coming in there as the CCO. And the company says with 9 months in the books, they're on track to reach their full year guidance that they've given there on the left. And they made this comment, which is certainly encouraging. It says, as customers benefit from efficiency gains with our solutions. As we said before, anytime a company's selling something that saves other companies money, that's a great thing. Now, a couple other things we noted. They adopted this CARE plan, which is all about sustainability, and they have goals like 33% female representation across the company. We could really care less the gender. Whether or not you sit up or you sit down or stand up to take a piss doesn't affect your ability to execute. So they should only be caring about redeeming themselves in terms of revenue growth and restoring investors' confidence. They also dumped Man U, so that's Manchester United for those of you that don't know, and they were criticized by investors for spending a lot of money on that, and that's could be seen as a vanity metric. It's like somebody paying to get clicks. The company argues, as you can see on this slide, that 20% of Man U's 1.1 billion fan base are business decision makers. And, they're also sponsoring over there at F1, and that 48 CEOs attended the last Mercedes-AMG Executive Summit. It doesn't seem like this is money well spent, and we're glad to see that they've stopped spending that money, because it's really hard to imagine that this brand recognition from seeing their name on a Man U jersey is what is going to convince a C-level person to purchase the product. It's more about functionality and capability. So another thing we wanted to talk about was the focus they have on bookings. And we always say that you should ignore bookings and focus on revenues, which is what we do. However, it depends on how a company defines bookings. And in this case, TeamViewer defines them as signed contracts. So there's 2 things to note here. First of all, the industry trend for SaaS companies is to decrease the contract duration. There's a number of reasons for that. We talked about that in our recent article on Alteryx, and I can put a link to that in the description of this video. It's interesting to read why they did that and how it affects your metrics. Well, TeamViewer is going in the opposite direction with 3-year contracts, and what happens there is that when they book a $12 million contract for 3 years, bookings will reflect the entire amount at the time that the contract is signed, okay? So $12 million in bookings. However, revenues get recorded differently. So you see they break them out over each of the 3 years, 4 million year 1, 4 million year 2, and same in year 3. And what that means then is you have this disconnect between bookings, which they seem to report a lot of their metrics in respect to bookings. There's going to be a focus on revenue. So they say this: with the ongoing transition from small to medium business to enterprise, more and more multi-year deals are being signed. They say, as a result, revenue is becoming increasingly relevant to measure actual business momentum. Seems counterintuitive. If that's the case, then wouldn't bookings be a better evaluation of what's coming, because that's essentially signed contracts? Well, they're saying, no, you need to pay attention to revenues. Fair enough, we'll pay attention to revenues, but then they ought to revamp their deck so that a lot of their metrics are reflected in revenues. For example, this slide here shows small to medium business billings by ACV, annual contract value is what that stands for, bucket. And these are the buckets. Actually, typically companies will put these buckets in terms of numbers of clients. They don't. It took me a while to realize that. They're actually doing this in millions of dollars, so it's somewhat confusing. But if you pay attention to the right-hand side here, this is the enterprise billings buckets, and this simply reflects the amount of money that a company is paying them. The bigger the amount, the better, the more likely they are to be in front of key decision makers. So you can see that enterprise billings by account value are growing in each one of these buckets. And you can see the buckets over there for small to medium businesses are much smaller. Another slide that's interesting to look at here shows on the bottom left, enterprise net retention rate. This is very important to pay attention to, right? Because remember we talked about company-wide retention rate falling because of the coronavirus and people not spending what they were before for remote connectivity because that's tailing off. And this focus on net retention rate shows their existing clients are paying more every quarter. And you want to see that above 120%. So it's still a somewhat weak metric, but it's good to see that the trend appears to be moving in the right direction. And then this slide is interesting to look at. This shows their cash. And if you walk through on the left-hand side there, they call this a bridge. And you can see cash starts at $550.5 million. And then it goes up based on operating cash flow. Yesterday's presentation, we talked about the importance of operating cash flow for VF Corporation and what that means. Then you can see that they have some money spent there on capital expenditures and M&A, so it drops. Then they paid some interest, it drops even more. Then they paid down a whole bunch of debt and drops there. Then they bought back a bunch of shares. And that's actually good to see because they're buying shares at a time when the price is quite depressed. We did a piece that specifically talks about the impact of share buybacks. I'll put a link to that in the description as well. Then they have some other, and you can see they end with cash of $89 million. Because their business is generating cash, that should increase over time. You can see that they still have liabilities, debt of around $635 million. That net is simply adding in cash. And then they refinance their debt, so around 33% of their debt now is exposed to variable interest rates. And then this last slide I wanted to show you, it's interesting. They show how they're actually best in class when it comes to augmented reality solutions. And I don't know what percentage of the revenues are coming from augmented reality. I didn't have a chance to try to figure that out. I don't think they made that obvious, and perhaps they don't even tell you, but you can see how they're up there with PTC. That's another company we cover, and we're due for an update anytime now on them. But you can see how they're best in class when it comes to augmented reality solutions. And that's certainly some of the appeal of the company from an investor's perspective, a disruptive tech investor's perspective anyways. And then just to conclude, TeamViewer needs to model other successful SaaS firms in terms of the metrics that they're using. They're profitable, so that ensures they're likely to survive. Growth will continue if they can save money for their clients as they say they can. So new management team and investor relations need to shake things up when it comes to the metrics they're reporting and it comes to how they're operating their business. So please put your comments in the comment section. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.